Good afternoon, everyone, and thank you for joining the session today on Achieving Wealth Success, where we'll be taking a deep dive into the net wealth approach. I'm going to wait for a couple of seconds just to let everyone log in before I get started on the introduction today. So first off, for introductions, my name's Lily Ball. I work on the advisory team here at Netwealth. And today we're going to cover how the Netwealth team can help structure your investments in the most tax efficient way before taking a closer look at our globally diversified and high quality portfolios. I'll touch on our portfolio performance and how this compares to the peer group, and then use a case study to highlight the importance of paying lower fees in the long term, the compounding effect this can have in saving clients thousands in unnecessary costs, and better enabling them to meet their financial goals. Finally, I'll finish off today by giving a demo of our proprietary technology, My Netwealth, that can help you with accessible and transparent financial planning. Thank you to everyone who sent in questions beforehand. I've done my best to incorporate these into the content today. But if you do have any questions during the session or would like to speak to a member of the advisory team about the Netwealth offering, or just any questions you may have and how this might work with the Netwealth setup in a bit more detail, then please do email the email address shown on the screen there, advice@netwealth.com, and we would be very happy to help. So where to start? Let's start with an overview of the Netwealth service in a nutshell and how we help our clients achieve wealth success. Netwealth positions itself as a modern wealth manager. We've retained all the best bits of traditional wealth management, such as access to expert advisors and the human touch, but we have focused on technology to enable our advisors to do a better and more efficient job for our clients. This also enables us to cut operational inefficiencies within the business, as well as provide a better, more transparent client experience with our technology, and so we can offer clients lower and more competitive fees, but importantly, without any compromise on the service received. I'm going to touch later on the Netwealth investment approach in a bit more detail and how this has led to our outperformance versus the peer group. But this slide in a nutshell is the Netwealth service and where we position ourselves. Namely, a modern service using technology to enhance our offering with an expert team of advisors and senior management, lower fees without a compromise on the service or the performance on offer. The Netwealth ethos is to focus on controlling the controllables to ensure the best outcomes in your financial plans and achieve wealth success. We had a question in beforehand highlighting the current geopolitical uncertainty in the world at the moment. And this is something importantly that's unfortunately out of our control. So whilst it's always important to be aware of these risks and what's going on, we find the best outcomes come from looking at the bits we can control. But to start with, let's look at the left-hand side of the slide here on what else we can't control. We can't control market performance and the impact geopolitical events may have on this performance. We can't control inflation and the current rates we see there, and we cannot control longevity or how long we live for. At Netwealth, we use our financial planning tools to model for these scenarios and the things we can't control, and I'll touch on how we do that in the demo at the end. But ultimately, they are out of our control. Moving across to the right-hand side to what we can control and influence, and by focusing on these instead, we can significantly impact our wealth and our outcomes. Firstly, spending time in the market. We can't control market performance, so trying to call the tops and the bottoms and jumping in and out of the market can lead to worse outcomes. Instead, by spending time in the market and riding through those waves of volatility, we can improve our outcomes. Diversification. I'll touch on this in more detail when we take a closer look at Netwealth's portfolios, but we can control how we're invested, and a well-diversified portfolio helps smooth the overall path of returns. Tax wrappers is next, and I'll talk about this a bit more in a minute, but maximising allowances, whether they're capital gains tax allowances, pension contribution allowances, or ISA allowances, we should be using all available wrappers to impact our wealth. And then finally, fees. Paying high or low fees is in our control by choosing which provider to go with. So make sure you do your due diligence, ensure you're paying a fair fee for the service provided, and this will significantly improve your outcomes too. Focusing on controlling the controllables is how we at Netwealth help our clients achieve wealth success. One of the controllables I just mentioned was utilising tax wrappers and allowances. So I'm going to run through now how our advisors help clients with this. Firstly, on this slide, a couple of planning considerations. Our advisors are on hand to help our clients, ensuring they are thinking about ways to be tax efficient in their financial plans. Firstly, pension contributions. So for additional rate taxpayers, for example, an increased pension contribution could make sense to take you back under the threshold and claim back the extra 20 or 25% tax relief from the government in your self-assessment tax return. So check how much annual allowance you have left for this tax year, and also use prior year unused allowances, as an increased pension contribution may better your financial circumstances and make sense within your financial plan. Moving on to ISA allowances, not just for an individual, but for an entire family, and thinking about that. Capital gains tax allowances, they may feel small at £3,000, and they have obviously been slashed in recent years, but utilising this allowance on an ongoing basis to rebase your book costs and prevent a large gain building up makes sense. And that's why we offer this service free of charge for all Netwealth clients. Tax efficiency is important outside of pension and ISA wrappers as well. I'm sure CGT is particularly front of mind for everyone at the moment with the budget next week and rumours rates may be increasing. So we are actually hosting a Netwealth First Look post-budget webinar the day after the budget next week. So do sign up to that if you haven't already and you are interested in hearing our thoughts. We will also discuss client impact of what gets announced too. Now I'm going to run through an example of how speaking with advisors and sound checking your financial plans to utilise your tax wrappers can have a beneficial impact on your outcomes. This case study looks at a family who, through an inheritance, have received £500,000. In the chart on the left, you can see they've invested the full amount into a Netwealth risk level 7 equity-based portfolio for 10 years. They don't need the funds, so they're invested for growth. And as you can see, after that 10 years has elapsed, the portfolio, after assuming 45% income tax and 20% capital gains tax, has grown to £645,000. This is a great outcome, and the after-tax growth is nearly £150,000. However, if the family had perhaps sound-checked this financial plan with an advisor at Netwealth and sought our guidance to utilise the family ISA allowances year after year to shelter the assets from tax, you can see that the portfolio on average, now on the right-hand side, will instead have grown to £730,000. Even if it's invested the same way, paying the same fees and getting the same performance, just from using those wrappers year on year, they end up with better outcomes. As you can see on this slide, a family with 2 parents and 3 children over 10 years have managed to get the full £50,000 into ISA wrappers, and the total pot is actually worth £85,000 more due to this saving, assuming average returns. So in that first graph there, you can see the GIA going down as they fund the ISAs each year, and you can see 2 adult ISAs and 3 child ISAs growing at the same time. Both outcomes on the previous slide were positive, both result in substantial growth, but being able to sound check your financial plans with a Netwealth advisor at any time often leads to better outcomes, as showcased here. Now I'm going to move on to our portfolios at Netwealth, how they're invested and how they've performed. As portfolios are, of course, a large part in achieving wealth success, even though we can't control for market performance. We had a question in beforehand on the difference between Netwealth investing and self-investing across a small range of trackers, and I hope to answer that question across the next few slides. The Netwealth investment approach is coined as active asset allocation with passive implementation. And what this means is our instrument selection, our cyclical positions, and our strategic positions are very much decided on an active management basis. They're looked at regularly by the team, who meet a minimum of every 2 weeks to discuss portfolio positioning. But how we choose to implement our active strategy is predominantly through passive funds, or ETFs, exchange traded funds. This is a deliberate choice, and the investment team have the freedom to invest in the entire stock and fund universe. But we choose to use passive funds because, firstly, we're not stock pickers. It's not what we're trying to do at Netwealth, and we believe it's notoriously hard to do and choose the next Tesla, for example, before it becomes a Tesla. Instead, we choose passive funds as when looking at the data and comparing active funds to passive funds over different regions and different time horizons, passive funds tend to outperform active funds when you account for performance net of fees. This is because active funds levy high fees and often do not deliver better returns, so we choose to implement our active investment strategy through passive funds and pass these lower fees on to our clients. If, of course, this data changes, active funds start outperforming, our investment strategy will be revisited. We're not restricted in what we can invest in. Netwealth build clients' core investment holdings with a focus on liquid and low-cost multi-asset exposures. Now, these multi-asset exposures can be hard to implement on a DIY basis. For example, fixed income exposures through different government bonds or corporate bonds are notoriously hard to replicate when you're doing DIY on an individual basis. And even though the implementation is passive, the management at Netwealth is very much active. So if you're planning on doing passive through DIY, if you have the time, expertise, and inclination to be looking at your portfolios and repositioning them to be best suited for market moves, whether expected or unexpected, then this might be the approach for you. But we typically see clients with busy lives who no longer have the time, experience, or the inclination to continue with the DIY journey. I highlighted the importance of multi-asset portfolios that are well diversified when I discussed controlling the controllables at the beginning. So I wanted to take some time now to show the benefits of diversification in action. On this slide here, we have the performance of fixed income in the grey bars, so bonds, and the biggest intra-year drawdown of equity markets in the blue. So comparing here over the last 20 years, how bonds have performed when equity markets are having a tough time. And as you can see here, looking at 2008 for an example, during the global financial crisis, you can see equity markets were down in that year by 10%. The benefit of diversification and having a portfolio that's multi-asset, so includes fixed income bonds as well as equities and other things, is shown as in this time period when equity markets are down, fixed income is actually returning over 10%, thereby providing a protective layer on the portfolio, particularly noticeable in times of market stress. So hopefully highlighting here the benefits of diversification and having a well-diversified multi-asset portfolio. But this negative correlation between equity markets and bond markets isn't always perfect, as will be fresh in everyone's memory, I'm sure, 2022, if we look there, where both equity markets and fixed income markets sold off together as central banks around the world were hiking interest rates globally to curb inflation rates. But nonetheless, the point remains that a well-diversified portfolio is something that's in our control and vital to achieving wealth success. On this slide here, I wanted to show you diversification in action across Netwealth's different risk levels. As you can see, across the top, we have the asset allocation of our 7 different risk levels, with fixed income in the blue shades, alternatives in the yellow, and equities in the different shades of green. As we move up the risk spectrum, so 1 on the far left, up to 7 on the far right, equity markets in the green shades become more dominant. But even within our equity components, we're well diversified by sector and geography. So our equity exposure is split between the UK, the US, Europe, Asia, and emerging markets. And even on the lower part of this slide here, you can see the same 7 risk levels again, but showing our diversification through currencies. So GBP, USD, the Japanese yen. So our portfolios are diversified by region, sector, asset class, currency, and that's across all 7 of our risk levels to control the controllables and help clients achieve their financial goals through well-diversified portfolios. We had another question in beforehand about how much equities should feature in a portfolio given a set time horizon for investment. I believe this question was specifically asking about a retirement portfolio. Now, as you can see here, even in our lower risk portfolios, looking at risk level 2, as they're multi-asset, equities still feature, but in a less dominant position than for risk level 7, for example. And the amount of equities in one's portfolios should, of course, be determined by how long you envisage to have the portfolio invested for, but also importantly, your willingness to take risk. You might have a 10-year time horizon and want to target growth and look to risk level 7. And with this time horizon, you have the ability to take maximum risk and be heavily invested in equities. But you might not be comfortable with the volatility often seen in these high-risk portfolios. And so opt instead for a more balanced portfolio based on your willingness to take risk in combination with your time horizon. Selecting risk levels is something that the advisors at Netwealth often help clients and prospective clients with. And so it's not a decision you have to make in isolation at Netwealth. You can have help and guidance along the way. Now to touch on performance and our portfolio performance. So on this slide here, you can see the performance across our 7 risk levels since our portfolio inception in May 2016 to the end of the quarter that we've just had, so the 30th of September. As you can see, higher risk, higher return in that dark blue line at the top for risk level 7, but it is a bumpier path to get there. On the far right-hand side in that table, you can see our total returns since inception, but also our annualized returns since inception. So you can see that on average, the annual returns for risk level 7 are 8%, 7% for risk level 6, and so on. These returns, importantly, are shown net of the net wealth management fee and all charges associated with the underlying investments. But if you would like further details, both on the asset allocation or our performance information, or both, then please do email advice@netwealth.com and we'd be happy to share the full performance and full asset allocation packs with you for your review and run any comparisons that you would like us to against your current setup. On this slide here, I've shown the same performance data for the Netwealth portfolios since inception to the 30th of September in the blue and compared with the ARC benchmarks in the grey. Now, ARC stands for Asset Risk Consultants, and they're a third party who amalgamate the performance data of over 100 wealth managers in the UK. So including St James's Place, Barclays, Citi, Vanguard, and obviously many, many more. They produce a peer group average every single month. So as you can see from the chart here, since our inception in May 2016, we're very happy to report outperformance across all of our portfolios relative to the respective ARC benchmarks. This in part is due to the team's superior positioning and making the right calls in markets, but also due to the positive tailwind that we get from our lower fees that enable clients to take home more with better net returns. So our portfolios, their diversification and performance is another way that the Netwealth approach helps clients achieve their goals. Moving on to talk about fees in more detail and why low fees are so important for meeting your financial goals. Now, it's all very well seeing the fee figures and numbers written down and comparing that, but sometimes it can then be hard to visualize just how much of an impact 0.5% or 1% fee difference can actually make. So in this next section here, I'm going to run through a few case studies and show just how impactful fees can be and how this can affect your investment returns over time. On this slide here, we show how low fees make a big difference. So on this graph, we have £250,000 portfolio invested with Netwealth in the dark blue line or a more traditional wealth manager in the grey. Now, for the purpose of this illustration, we've controlled for performance and are assuming that both portfolios are invested in the exact same way, both growing with an annual return of 5% a year. So controlling completely for performance or investment differences and seeing the difference between those two lines down to the impact of fees and fees alone. So for investment management at Netwealth on a £250,000 portfolio, you qualify for our 0.6% net wealth fee. And we've added the 0.3% underlying fund and trading costs too. So you get a total all-in fee of 0.9% for that amount. Now, for the other portfolio, we've assumed 1.65% investment management fee, trading and underlying fund costs. And we got this traditional wealth manager fee from some research by Numis and Citywire. We did have a question in before on peer comparison for fees and what data to use. And obviously this is an average and it will vary from provider to provider. But often some underlying fund costs are difficult to find because providers aren't as transparent. And this is why at Netwealth, if you are interested in a full cost comparison, our advisors will happily run this for you free of charge, doing the digging, working out all your fees at your current provider and letting you know what the exact same setup would be at Netwealth and what this would cost. We can then produce a graph such as this, personalized to your specific setup. So do please contact us at advice@netwealth.com and we will be happy to run your cost comparison for you to justify our claim of lower fees and let you know just how much you could be saving on a personalized basis rather than these figures. But back to this graph, as you can see, the impact of a 0.75% fee difference, which may feel negligible versus the aggravation and the admin associated with moving your funds to a different provider, can actually have a profound impact on your portfolio when this difference is compounded over time. And by the end of this 20-year period, you can see the difference between those two lines is stark. And by being with a different provider, achieving the same service but at a lower cost, you could save over £75,000 in fees alone. And that's not negligible when in pounds and pence compared to how 0.75% may feel. That £75,000 difference in any portfolio is welcomed at any stage of life. But specifically, if we think about a retirement pot, for example, that equates to the difference between a higher level of income attainable throughout your hard-earned retirement or your retirement income lasting longer. And so that's what I'm going to spend a bit more time on now with a retirement case study. This case study specifically focuses on the impact fees have on a retirement pot. So here we're looking at an individual who's 60 years old, looking to draw an income from their investment portfolios. Their portfolios total 1 million altogether, with the bulk of the assets in a pension account, as is the case for most people. And they're looking to draw a retirement income of £2,750 a month net of tax from their portfolios starting now. As you can see here from this projection with inflation applied, by the time the client reaches age 95, they've met their objective and achieved their desired income for their portfolios, and they have over £365,000 remaining at age 95. And all of that is in their pension account, assuming the average scenario and drawdown strategy. And it being in the pension at the end is important and beneficial from a financial planning perspective, as where rules currently stand, your pension falls outside of your estate for inheritance tax purposes. And so this client has achieved an objective of their investment portfolio providing an income throughout their retirement, and they've also been able to pass on a nice nest egg to the next generation with the funds left in their pension at age 95 that can pass to their beneficiaries outside of their estate for inheritance tax. Now, if we look at the exact same inputs to the same projection on this slide, clients the same age, their investment strategy and performance is exactly the same, their investment pot's 1 million, and they're still looking to draw £2,750 a month net. The only difference between these two projections that I've shown you is a 1% difference in fees. And that's the difference in fee that we commonly see at Netwealth when running our cost comparisons that I mentioned before. So if we look at the average outcome in this scenario, you can see that the funds run out sooner in 2056 due to that compounding impact higher fees have on your portfolio and the drastic effect this can then have over time. Now, this 1% fee difference means 5 years less retirement income. That might not feel too important, as the previous slide did model to age 95, which is something that we do at Netwealth for prudence. So the funds running out at age 90 might not feel like an issue for some people, but that fee saving could instead translate to are higher retirement income levels. If you pay 1% less in fees, you might be able to draw more than £2,750 a month. And as I touched on in the previous slide, if inheritance tax and passing wealth on is an objective for you as well, all investment portfolios, including the pension, are depleted in this example, and so there's nothing left to pass on to the next generation. So by paying 1% less in fees, your retirement income lasts longer, you may be able to afford to take a higher level of retirement income than you initially thought, and you have a nice nest egg in the pension left to pass on to your loved ones after first and foremost meeting your own needs through retirement. So fees are really important all the time, but particularly when looking at retirement, whether this is paying lower fees now at a younger age and giving your retirement pot the best chance of growing as much as possible instead of getting eaten away by those higher fees, or paying lower fees now if you're in retirement to ensure that that pot lasts for the desired number of years and the income you can take from the portfolios is the highest it could possibly be. So control the controllables, ensure you're paying a competitive fee for the service provided. And as I said, if you'd like to run comparisons between your current setup and what that exact same service would look like at Netwealth, as I mentioned, do get in touch with our advisory team and we'd be happy to run this comparison for you free of charge. So a lot of talk on fees there, but now quickly I'm just going to run through what Netwealth charge for our service, starting with our investment management fees. As is typical for wealth management, the more you invest with us, the lower your fee is. And that investment management charge at Netwealth is shown on the top line there, and it varies the more you invest. The estimated underlying fund costs and costs of trading don't vary based on the amount invested, and combined come out at around 0.3% to be added to your total costs for investing. We believe in providing full and transparent fees, and often other providers will not quote or make easily accessible the fund and trading costs, as they're not necessarily levied by the provider, but rather a byproduct of what you're invested in and how you invest. So when making fee comparisons, do be sure to find out these figures too, or of course ask us to do it for you. Now, that top line, the Netwealth investment management fee, is an all-in fee, which includes, of course, investment management, but also custody and administration, VAT, tax reporting, and transaction fees. So it's also worth mentioning, in that Netwealth management fee that you pay, you get access to the advisory team, to the team that I sit on, to help design portfolios, discuss performance and positioning, and act as a sounding board to your financial plans whenever required. So that's the investment management service and the associated costs at Netwealth. And now I'm going to talk a little bit on advice at Netwealth and the different fees associated with this. Financial planning advice is a separate offering at Netwealth, as we don't believe you should be getting charged for it if you don't need it and instead only need the investment management. But it is an offering that you can pick up at any time as a client, either on an ongoing or a one-off basis where applicable. Ongoing advice includes an initial setup piece and then meetings at least twice a year or more if necessary, as we will reach out proactively if anything comes up in the interim that could impact your financial plans. One-off advice is, as it says on the tin, you don't actually need to have investment assets with Netwealth to take a one-off piece of advice, and we can give you a quote at any point on what that's going to cost, what we can include, what we can't include. On what we can and can't include, our advice covers a variety of topics, and this can be completely personalised to what you might need, including or excluding from the report. So we can cover things from asset allocation to drawdown strategy, estate planning, retirement planning, income analysis. So if you would like to find out more specifically on advice offerings at Netwealth, we have much more information we can share, and you can of course have a complimentary consultation with a member of our advisory team to discuss what might be relevant in your circumstances, where we can help, and this can of course give you a better idea on the process of advice, the fees associated with a piece that you might be looking for. So if this is of interest, please do contact advice@netwealth.com to find out more on our financial planning services. The fees for the advice service, as mentioned, this can be one-off or ongoing, and each has different fees, as you can see on the left-hand side. So the one-off advice is £200 per hour, and the price is agreed prior to any work taking place, so you're not blindsided by the bill coming through. And the ongoing advice is an extra 0.35% on top of the investment management charges. Now, to the right-hand side there, we do also have one-off advice fixed packages with a fixed price for more common pieces of advice work, such as drawing down in retirement and pension contributions. So they're a fixed cost of £1,200 or £400 respectively. As mentioned, if you're interested in finding out more specifically on the advice side, please do get in touch and we can discuss what might be relevant for you. So finally now, I'm going to switch screens and show you some of our Netwealth planning tools. So you can register to use these tools for free. You can register to use tools for free at my.netwealth.com, and they can really help aid oversight on your financial plans. So there are two parts to My Netwealth. Let me just log in here. Let's reload that. Sorry, I've probably just had it open for too long. Bear with. Perfect. So let's go across to, so as I said, two parts of My Netwealth that are useful for your financial plan. Wealth Tracker and the Wealth Planner. I'm going to start first with the Wealth Tracker. So this tool can be used to track multiple accounts across multiple different providers just by clicking this blue button here to begin tracking an account. I'm logged into a demo account right now, and as you can see, their Netwealth account automatically pulls on here, but they've also added accounts with Hargreaves Lansdown, Jupiter, AJ Bell, etc. Where this tool is useful is if we go into the AJ Bell holdings, for example. Here you can see they hold units of this balanced fund. Now, people may not be aware of the underlying investment composition of something simply called a balanced fund. So this tool sort of takes an X-ray view and looks at the underlying holdings and lets you know how much of that is actually allocated to equity, fixed income, cash, etc. in that fund, providing a useful layer of oversight that you might not have previously had on your investments. So you can add different holdings using that button here, add holdings, and simply type in the name of the asset that you'd like to track. And then if we go back to the wealth tracking homepage, once you've inputted this information across all of your accounts, you can then see a very useful overview here of your total asset class exposure. And this may reveal things that you weren't aware of. For example, this client might not have realized that actually over 80% of her assets across all those different providers are actually in equities, and so may adjust her financial plan accordingly. You can also see here the split by account type, so how much of it is in wrappers, how much isn't, and then finally here you can track the value of all of those different accounts in one place over time. So that's the wealth tracker. The other tool on My Netwealth that I wanted to is this automatically pulls the information on account types, size and risk taken from the wealth tracker and inputs it into the plan. So over here, you can add information about yourself and your goals. So this individual, for example, is 53. They plan to retire at 65. Their current salary and target monthly income net of tax is there as well. And you can then run the projection. This projection has already been run. So if I hover over these dots here, you can see the different things happening and also the projected wealth at those points, assuming either strong, average or weak market scenarios. So here at 55, for example, if we hover over that, there's a one-off withdrawal for a new car of £25,000. Across at 57, another withdrawal for a holiday. And if you keep going along, the wealth is growing, it's accumulating. There's a few different dips there for the different withdrawals. But if we get to 65 here, we then see retirement. What would her wealth look like at the time? And in average scenarios, it will have grown to around 2.6 million. Then she'll start drawing her £7,500 a month net of tax. And if we keep going along, you can see how that drawdown impacts the growth of the portfolio. And then you can see here at age 79, there's another withdrawal of £100,000 for health costs. And then we can see at age 95, this pot is dwindling. We model at Netwealth to age 95 to try and control for longevity risk, which, as we know from what we discussed earlier, is something that's not in our control. So you can see the plan here says the funds are close to lasting to age 95, but adjustments could be needed. And down here, a little bit further, if we scroll down, it gives you some advice on adjustments that you could make and some suggestions on how to better plans, like reduce income target or increase the amount that you're saving before you get to this point. There's also importantly a button for explaining the assumptions that we use in the modelling, and also an option there to book in some time to discuss the wealth plan and any questions that you might have with a member of the advisory team. So if we go up and edit the plan, we're going to edit our inputs. We're going to change the information in you and your goals from the target net income from 7,500 just to 7,000. We're going to click save there. We're going to go back to the projection and we're going to rerun the projection. Once this finishes running, you can now see that we're more on track to meet our goals by reducing that income slightly. So you can play around with these projections and you can see the difference at age 95. I think before it was much substantially less than nearly £2 million left in the pot. So you can play around with the projections, use these tools, add your own inputs to get an idea of your financial plan, how viable it is, and speak to a member of our advisory team on how we can help. So please do register and use these tools. So it's my.netwealth.com to register and use these tools. And hopefully this gives you an idea of the technology that we have available at Netwealth, alongside our investment management and advisory offering that can help you visualize your financial plans and hopefully meet your financial goals. So I'm just going to change the screen back now to the presentation. Here we are. So in summary of what we've covered today, when looking to achieve wealth success, focus on controlling the controllables. Spend time in the market rather than trying to time it. Ensure you're with a provider who has adequate levels of diversification in the portfolios, or indeed, if you're managing your investments yourself, look to be diversified, utilize tax wrappers, and ensure you're paying a competitive fee without having to compromise on the service. Please do use our tools like My Netwealth to visualize your financial plans, and of course, seek formal financial advice from Netwealth where applicable. So thank you all for your time today and the questions submitted beforehand. I hope you found the session useful, and if you have any questions or would like to speak on the Netwealth approach in a bit more detail, please do reach out to advice@netwealth.com and we would be very happy to help. I hope you all have a great rest of your day.